for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay? But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to 8,000 bucks now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. Well, for about 100 years now, we've had the phenomenon of governments excessively pushing the pedal and using money as their tool of survival, okay? And in the process of decaying the real buying power of their money units, euros, yens, dollars, whatever, such that, what I mean decaying the value of money? When your granddad built a house, it cost him $4,500. Now it's $450,000, okay? That's an example of degradation of money over, a span of 100 years. It's created boom-bust cycles. We've seen them. We've seen monetary excess, and then stock market booms, and then stock market peaks and goes down regardless of whether the Fed cuts rates to try to defend it. It goes down anyway, and you get these boom-bust cycles created by monetary excessive flows, lower interest rates than reality would have them. Various monetary policies like QE, which they engaged back in 2008, which is now in their quiver, okay? You break the stock market in a few of the, especially certain arenas that I've been mentioning, including, by the way, the banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom-bust cycle game where they come in, they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point, will that work again? We argue no, this time it won't. This time the boom-bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period, plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher, okay.
The Federal Reserve's toolkit, rate cuts, asset purchases, and emergency liquidity, has historically delayed crises. But experts warn this time may be different. The U.S. stock market has seen its longest and most explosive bull run, with the NASDAQ rising nearly 20-fold since 2009. These extremes rival no precedent in financial history. When this bubble breaks, the fallout could extend beyond Wall Street into everyday life, hitting jobs, savings, and retirement accounts. Unlike 2008 or the dot-com collapse, the next downturn may be global in scope with far deeper social and economic consequences.
When that breaks, real-world consequences occur. This time, I think they'll be so severe, and also global, although we're a prime bubble. Some areas of the world aren't. China, for example, does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real-world, in-the-street consequences where certain things that we all take for granted but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay? It's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay? Which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to raise the money, et cetera, that it can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
Central banks, once trusted as stabilizers, are facing growing scrutiny. Why should governments monopolize money, the very foundation of trade and human interaction? Critics argue that this monopoly is more manipulative than any market distortion, even price fixing of basic goods. As debt escalates and confidence erodes, more voices, even inside politics, are questioning the Federal Reserve's role. Some suggest radical change, replacing income taxes with sales taxes, or even dismantling the Fed itself. These are no longer fringe ideas. They're entering mainstream debate as people lose faith in institutions that promise stability but delivered recurring crises.
Yeah, I think a lot of people think of Trump as free market, and I don't think of him that way. He's very interventionist in a lot of things, not merely government agencies, but, send troops here, send troops there, do this, then change it and do that. Tariffs here. Tariffs are taxes, after all. They get passed along in the process. And some people recognize that, even people on the right who used to be Republicans and now are no longer part of the Trump party. And even Trump likes also to print money. Back, before COVID even hit, he was talking about we need to cut rates below the Europeans and get them to zero. Because why? We should have cheaper bonds than they do in terms of the interest rate. We shouldn't have to pay so much for service our debt. And so he told the Fed then, but he didn't do anything about it. Fed later did cut rates to near zero. But anyway, the point, he's still talking that way. I want rates at 1%. Well, that's not a market pricing of an essential commodity. That's a government edict. And so naturally he wants to control the Fed to control that aspect of the economy. Well, Mussolini would have liked that too. Pardon me for saying that, but that was his view of his adaptation to socialism. Wasn't we nationalize companies and so forth, but we control them from above without seizing them. And we control money and so forth. And Vance, though, the other day made an interesting statement. He said, why should we have a group of academicians determining the price of money?
Energy and commodity markets could act as catalysts for the next crisis. Oil prices are hovering around 65 to 70, but technical indicators suggest an imminent breakout. A sudden surge would directly hit consumers at the pump, reigniting inflation fears. The Bloomberg Commodity Index also signals potential upward momentum. History shows that when commodities spike, they amplify political and economic instability. From food costs to industrial metals, sudden price shocks can ripple across the global supply chain. If oil or other essentials climb sharply in the coming months, the resulting financial strain could accelerate doubts about central bank credibility.
In other words, he was questioning intellectually the even existence of a Federal Reserve, which a few libertarians have done, but now even the VP mentioned it. Now, Trump hasn't because he'd like to control it, get rates down. But these are the kind of changes I'm talking about. What will cause them? events, trends, and pain. And if we're correct in our analysis, monetary metals are going up. Two, certain other assets are going down that are bubbles. And also certain other areas will ambush, I think, the average guy. Remember, the guys who voted for Trump were, one, the GOP regulars, but also blue-collar workers who said, hey, he's going to keep prices down, particularly gasoline prices. And this year we saw lower prices. Well, that wasn't because of Trump. That's because oil has been under pressure, and so have commodities. But our technical analysis of the commodity category, and particularly crude oil, is that you can't sneeze on the upside, because if you do, you're coming up out of here big. There's going to be a whole nother commodity upwave, like we saw between late 2020 and 2022 when commodities doubled. Still at low levels on the Bloomberg when it did double, but it doubled. And I think we are in a technical situation where that's one of those ambush events that will help cause doubt and pain. Because when you're pumping the gas and all of a sudden it's 50% more than you paid 6 months ago, because oil goes from, we've got a major breakout starting next quarter at $68. Well, we're trading 64 plus right now. You go up $3 or $4 more between now and next quarter. In next quarter, that's going to be a breakout level. And oil's going to surge. And I'm not going to explain why, because I don't know why. Don't care. But technically it says I'm going up. And the Bloomberg Commodity Index is in the same position. So again, here's an event that could occur. It's likely to occur in our assessment. And when it does, it's going to be an upset factor, meaning emotion. And it's when you get the emotion in the game, that's when all of a sudden hands go in the air and you look around and say, where should I be? Well, you look at the charts and tell me, okay?
In this environment of uncertainty, monetary metals are regaining prominence. Gold has already surged beyond its long-term averages, reflecting structural distrust in fiat currencies. Historically, gold has delivered eightfold gains during past cycles, such as 1976, 1980, and 2001-2011. By that logic, today's rally could push gold toward $8,000 an ounce. Silver, often called gold's volatile cousin, may follow by breaking its $50 high and potentially doubling beyond. Unlike short-term rallies, analysts believe this cycle could entrench metals as institutional stores of value again, reshaping their role from speculative hedges into recognized forms of global money.
We've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there, and that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because of a declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pulled back from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines, and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade. which would create what? Total panic on the part of central banks.
All signs point to a convergence of pressures: inflated asset markets, rising commodity costs, political upheaval, and waning faith in central banks. Gold and silver may not just climb, they could become anchors in a world questioning fiat money itself. If confidence collapses, radical reforms could follow, from tax systems to the very existence of the Federal Reserve. The coming decade may resemble the 1970s inflationary storm, but on a much larger, more interconnected scale. For investors, savers, and ordinary workers, the message is clear: prepare for volatility as the financial world edges toward dramatic transformation.
For silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay? But if you historically, and I've said this over and over, and I'm not predicting the price because they could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.